In this retirement planning video, we will provide an overview of your VCERA benefits, walk you through the process of retiring from VCERA, and then offer you some things to consider as you plan your retirement. Let's start with what VCERA is. The Ventura County Employees Retirement Association is a multi-employer, defined benefit public pension plan that provides service retirement, disability retirement, and survivor benefits to members and their eligible beneficiaries. Let's focus on one part of that definition, the defined benefit component. A defined benefit plan offers you the pension promise. The pension promise says that from the time you retire until the time you die, VCERA will pay you a monthly retirement allowance called a pension. This monthly pension payment is not based on how the stock market performs, and it does not depend on how much you've contributed from your pay into the retirement system. Not only that, but if you have an eligible spouse or registered domestic partner when you pass away, that person can receive a continuance of your monthly retirement benefit until the time of their death. This is a very long-term benefit provided to you by virtue of your accumulated service as a VCERA member. Your defined benefit plan also provides for disability retirement benefits, both service-connected and non-service connected, as well as survivor benefits. However, those topics will not be explained in this presentation. Lastly, VCERA has more than $5 billion in assets that are managed by professional investment firms. This frees members from the stress of having to make investment decisions that could affect their retirement income. Remember, your retirement benefit from VCERA is lifelong and does not depend on how the stock market performs. This is very good news. Also keep in mind that VCERA is not a retirement savings plan. VCERA is not a 401k or 457 plan, which rely on contributions and investment growth. Your VCERA benefits, on the other hand, are calculated based on formulas defined by law, not on how much you can save. With that said, setting aside additional money in your 401k and/or 457 plan is a very good idea. Please just be aware of the difference between the plan types and their benefits, and how they can all work together to bring up your standard of living in retirement. There are two types of members in VCERA: safety members and general members. Safety members include those who work in active fire suppression and law enforcement. Everyone else is a general member. Within those groups is another membership category based on when your membership began. If you joined VCERA prior to 2013, you entered as a legacy member. If you joined on or after January 1st, 2013, you entered as a PEPRA member. PEPRA is short for the Public Employees Pension Reform Act of 2013, a California pension reform law that changed some benefit provisions for new employees who joined VCERA and other retirement systems in 2013 or later. We will look at some differences between legacy and PEPRA members in a few minutes, but for now, let's consider just one: benefit tiers. VCERA members fall into a specific benefit tier within their membership categories, either safety or general, and then either legacy or PEPRA. You can think of these tiers as levels of retirement benefits. Each benefit tier has a corresponding formula that mathematically represents its level of benefits. Each benefit tier also has an eligibility requirement. For example, General Tier 1 includes members who were hired prior to June 30th, 1979. Their benefit formula is 2.35% at age 62, which means that if you are a General Tier 1 member who retires at age 62, you will receive 2.35% of your final average compensation for every year of retirement service credit you've accrued. General Tier 2 members were hired between June 30th, 1979 and December 31st, 2012. Their benefit formula is 2.1% at age 62. Both General Tier 1 and General Tier 2 are legacy tiers. VCERA also has two benefit tiers for General PEPRA members who were hired on or after January 1st, 2013. General Tier 6 does not have a COLA, but General Tier 8 does for county employees represented by SEIU. Both benefit tiers have the same formula, 2% at age 62. The meaning of the formulas may not be immediately clear, so let's add some numbers to help. Let's say you are a General Tier 2 member who plans to retire at age 62 with 30 years of service. Using your 2.1% at age 62 formula, we would multiply 30 years times 2.1%, which results in 63%. You would receive 63% of your final monthly compensation, whatever number that happens to be, every month for the rest of your life. Finally, General Tier 1 retirees are eligible for annual COLA increases. So are general member retirees of the county who are represented by SEIU during their careers. More on COLAs later. VCERA safety members also fall into a specific benefit tier within their category, one for legacy members and one for PEPR members. Safety members hired prior to 2013 are in Safety Tier 1, which has a formula of 2% at age 50. This means that if you are a Safety Tier 1 member who retires at age 50, you will receive 2% of your final average compensation for every year of retirement service credit you've accrued. For example, at age 50, 30 years of service times 2% equals 60% of your final average compensation, every month for the rest of your life. Tier 7 applies to safety employees hired on or after January 1, 2013. The safety PEPR formula is 2.7% at age 57. Both safety tiers are eligible for a COLA in retirement. For more information about benefit tiers, please visit the Benefit Tiers page at VCERA.org. So, when can you retire? This is a frequently asked question at VCERA. The answer depends on whether you are a legacy or PEPR member. Legacy members, again, those employees who joined VCERA prior to 2013, must, at minimum, be age 50 and have 10 years of retirement service credit. There are two exceptions to the age rule. For general members, if you have 30 years of service credit, you can retire before age 50. This is very uncommon. For safety members, if you have 20 years of service credit, you can retire before age 50. Alternatively, any legacy member who reaches 70 years old can retire, regardless of years of service. The minimum age and service eligibility requirements for PEPR members are slightly different. General members must be, at minimum, age 52 and have 5 years of retirement service credit. Safety members need to reach age 50 with 5 years of service credit. Or any PEPR member who reaches 70 years old can retire, regardless of years of service. Earlier in the presentation, you learned that VCERA is a defined benefit plan and that your lifetime retirement benefit will be based on a formula. As with any formula, there are factors. Here are the 4 factors VCERA considers when calculating your monthly benefit. The first is your age at retirement. VCERA literally pays you to get older, to a certain point. Every quarter year older you are, up to these ages, will increase something called your age factor. More on this subject in a moment. The second factor is your total years of retirement service credit. This is service you earned by working and serviced that you purchased. Third is your final average compensation, or FAC. This is your highest average 12 or 36 consecutive months of retirement earnings, also known as compensation earnable or pensionable compensation. Let's spend a moment unpacking these terms. The FAC period, also known as your measurement period, is either 12 months long or 36 months long. The FAC period for General Tier 1 and Safety Tier 1 members is 12 months. The FAC period for all other members is 36 months. So, if you are a General Tier 2 member when you retire, VCERA will scan your entire salary history and find your highest 36 consecutive months of retirement earnings. And then VCERA will determine the monthly average. The same thing will happen for a General Tier 1 member, except the salary scan would find the highest consecutive 12 months of pay and then determine a monthly average. The next important question is, what kinds of pay items are included in your FAC? Your base salary is always included, as well as any pay items deemed pensionable by law. The pensionability of these pay items varies based on whether you are a legacy or PEPR member. Generally speaking, legacy members have more pay items included in their FAC. Examples of pensionable pay items for legacy members include the flexible benefit credit, educational incentives, uniform allowance, scheduled overtime, and annual leave and vacation redemption. As you approach retirement, a VCERA benefits specialist can tell you which pay items will be included in your final average compensation. The fourth and final factor used by VCERA to calculate your pension is your benefit tier. As you now know, each tier has its own formula, which will certainly affect the calculation of your monthly benefit. You will see an example scenario at the bottom of this slide. Here we have a General Tier 2 member who retired at age 60 with 20 years of service and an FAC of $7,500 per month. Based on this member's benefit formula and factors, she would receive a retirement benefit of $2,830 per month. Because the member was vested, she would also receive a supplemental benefit of $108.44 per month. And if this member was represented by SEIU, she would qualify for a 2% cost of living adjustment that compounds annually. There's one more thing to note before moving on. It concerns the supplemental benefit mentioned a moment ago. Employees who joined VCERA before 2006, and those who joined VCERA in 2006 or later and are vested, meaning they have at least 5 years of retirement service credit, they will receive a fixed supplemental benefit of $108.44 per month in addition to their base monthly benefit. Like your regular monthly benefit, this supplemental benefit is vested and payable for life. There's no one-size-fits-all retirement date. Your decision on when to retire will depend on life factors that are unique to you and your needs. However, there are a few things to consider when zeroing in on a retirement date. They could even result in a higher benefit. The first consideration is your age at retirement. Your pension will increase every quarter year older you are, up to a certain age. That maximum age factor depends on your benefit tier. For Safety Tier 1 members, your benefit will increase up to age 55. For Safety Tier 7 members, up to age 57. For General Tier 1 and Tier 2 members, up to age 65. And for General Tier 6 and Tier 8 members, up to age 67. Reaching your next age factor will bump up your benefit. A second consideration is your service credit. If you have eligible service credit to purchase, such as an unpaid medical leave or military time, you can buy that past service and receive credit for it just as if you had been a VCERA member during that time. Purchasing that service will increase your retirement benefit because it will increase your total service credit, but more on that subject later. A third consideration concerns your final average compensation, or FAC. The higher your FAC, the higher your retirement benefit from VCERA. Lastly, if your benefit tier makes you eligible to receive a cost of living adjustment as a retiree, you could become eligible for that COLA in the year you retire. Members with retirement dates on or before April 1st will qualify to receive the COLA for that year. But if you retire on April 2nd or later, you cannot begin receiving it until the following April. Safety retirees and General Tier 1 retirees are eligible for a COLA of up to 3%. The exact percentage awarded depends on the annual change in the Consumer Price Index for the LA region. If inflation over the past year exceeded 3%, the excess will be banked until it is applied in a future year when inflation is less than 3%. General Tier 2 and Tier 8 retirees who were represented by SEIU, that is for service on or after March 16, 2003, will receive a fixed 2% COLA each April regardless of inflationary changes. These four considerations are important in your retirement planning. For more information on these topics, please call VCERA. When you file for retirement, you will have 5 retirement options from which to choose. Think of these as payment plans for your monthly retirement benefit from VCERA. The main 2 differences between the options are, number 1, the monthly benefit paid to you, the retiree, and number 2, what happens to that monthly benefit when you pass away. These 5 options will be listed on your retirement application, but we will explain each one to help you get a sense of which option may be best for your situation. Keep in mind, once you receive your first retirement check, the option you elect is irrevocable. The unmodified option is by far the most commonly chosen by prospective retirees. It pays you, the retiree, the highest monthly retirement benefit, with the provision that 60% of your benefit continues after your death to an eligible beneficiary, such as a surviving spouse. To be eligible for that monthly continuance, your surviving spouse must have been married to you for 1 year prior to your retirement date, or be age 55 or older and married to you for 2 years prior to your date of death. If you do not have an eligible spouse, the monthly continuance may be payable to your unmarried minor children until age 18. The minor children benefit can continue through age 21 if they remain unmarried and enrolled as full-time students in an accredited school. However, if there is no surviving spouse or minor children at your death, and if the total benefits paid to you did not exceed your total accumulated contributions on deposit at VCERA when you retired, VCERA will pay your designated beneficiary or estate a lump sum payment of the remaining balance. Again, the unmodified option is the most popular because it pays you the highest monthly benefit, guarantees a 60% continuance benefit to an eligible beneficiary, and allows you to name a new spousal beneficiary after retiring. Option 1 pays you a slightly reduced monthly retirement benefit with the provision that your accumulated contributions at VCERA, minus all the monthly annuity payments received by you, will be paid to your beneficiary as a lump sum upon your death. In other words, if at your death you have not drawn more in monthly retirement benefits than you contributed during employment, any remaining retirement contributions will be paid to your designated beneficiary. This option preserves your contribution balance for up to 10 years so that if you don't have a spouse, domestic partner, or minor child to receive a continuance, there is at least something to leave to your beneficiary if you pass away early in retirement. Remember, your VCERA benefit is still payable throughout your life, regardless of your contribution balance. Finally, Option 1 allows you to designate your estate as your beneficiary and to name a new beneficiary after retiring. Option 2 pays you a reduced monthly retirement benefit with the provision that up to 100% of your benefit continues after your death to your spouse or a beneficiary who has an insurable interest in your life. To put it simply, this is someone who would suffer a negative financial impact if you passed away. The amount of your retirement benefit is directly affected by the age of your beneficiary. The younger your beneficiary, the greater the benefit reduction because of their longer life expectancy. The 100% lifetime continuance is payable only to the beneficiary you name at retirement and may not be changed later, even if the beneficiary predeceases you. Upon the death of you and your beneficiary, VCERA will issue no additional benefit payments. Also, there is no provision to refund any remaining contributions if both you and your beneficiary die before VCERA pays out your accumulated contributions. Option 3 pays you a reduced monthly retirement benefit with the provision that 50% of your benefit continues after your death to your beneficiary, who must have an insurable interest in your life. The amount of your retirement benefit is directly affected by the age of your beneficiary. The younger your beneficiary, the greater the benefit reduction because of their longer life expectancy. The 50% lifetime continuance is payable only to the beneficiary you name at retirement and may not be changed later, even if the beneficiary predeceases you. Upon the death of you and your beneficiary, VCERA will issue no additional benefit payments. Also, there's no provision to refund any remaining contributions if you and your beneficiary die before VCERA pays out your accumulated contributions. So, options 2 and 3 work the same way, but option 2 provides a 100% continuance and option 3 provides 50%. Because option 2 provides a larger percentage of your benefit after death, the reduction to your monthly benefit is larger. Option 4 is like option 2, but provides for multiple beneficiaries. This option pays you a reduced monthly retirement benefit with the provision that up to 100% of your benefit continues after your death to your surviving beneficiaries, who all must have an insurable interest in your life. At retirement, you specify the percentage each beneficiary will receive upon your death. The amount of your retirement benefit will depend on the age of your youngest beneficiary. The 100% lifetime continuance is payable only to the beneficiaries you name at retirement and may not be changed later, even if they predecease you. Also, if one of your beneficiaries dies, his or her benefit is not distributed among the others. Upon the death of you and your beneficiaries, VCERA will issue no additional benefit payments, and there is no provision to refund any remaining contributions if you and your beneficiaries die before VCERA pays out your accumulated contributions. The level income option is not one of the 5 retirement options. It is a separate optional program administered by VCERA that applies only to general members under age 62 who are integrated with Social Security. That includes general tiers 1 and 2 only. The level income option offers you a pension advance in which VCERA pays an increased monthly retirement benefit until you reach age 62. However, at that time, VCERA will reduce your monthly benefit by an amount that has an actuarially equivalent value. But if you file for Social Security at age 62, your adjusted VCERA benefit plus your Social Security benefit should represent a level income throughout your retirement, hence the name Level Income Option. Ultimately, the issue comes down to whether you want more money earlier in your retirement or later. The Level Income Option provides more retirement funds earlier in retirement. If you plan to choose this option, please supply VCERA with a recent earnings and benefits statement from Social Security. This will allow VCERA to calculate a temporary annuity amount payable until you turn 62 years old. Finally, please keep in mind the following. your VCERA benefit will be reduced by the full amount of your estimated Social Security benefit at age 62. It is your responsibility to apply for Social Security benefits at that time to ensure a level income. Depending on your public service employment history, you might be able to purchase retirement service credit in VCERA. Doing so could result in a higher retirement benefit and, in some cases, allow you to retire sooner. VCERA offers the following types of purchasable service. 1. Pre-membership. If you were hired before July 11, 1999, there might have been a delay up to 6 weeks between your date of hire and your date of entry into VCERA. If this applies to you, you may purchase this period of time, which VCERA calls pre-membership. 2. Extra help or part-time service. If you worked as an extra help or part-time employee prior to 1992 and were not a VCERA member, you may be eligible to purchase that time. 3. Unpaid personal medical leave. If you've had an unpaid period of service due to a personal medical leave, not family leave, that time might be purchasable. If so, be prepared to document your leave with medical notes. 4. Redeposit of refunded contributions. If you were once a VCERA member who terminated employment and withdrew your retirement contributions, and then later returned as an active VCERA member, you can redeposit those refunded contributions, plus interest, to regain your lost service credit. These types of service credit purchases are considered prior county or district service. If purchased, they will count towards your vesting and retirement eligibilities. But the next type of purchasable service, known as prior public service, will not count toward meeting those requirements, although the additional service credit will be added to your total, which will increase your monthly benefit. If you served in the active military, U.S. government, or California state government, or for a California city or county, or for a local public agency in Ventura County, you may be able to purchase that prior public service. To be eligible to purchase any of these service types, you must follow a few rules. First, you can't be entitled to receive a retirement benefit from another retirement system for that prior work. That would be what is commonly termed double dipping. Second, only these specific service types are purchasable, no others. Third, you may be required to document your prior service. For example, a military veteran must supply a DD-214. And fourth, you must pay for the service purchase in full before you retire. VCERA offers multiple payment methods, including check, payroll deduction, deferred compensation rollover, or a combination thereof. You can download a service credit purchase form from VCERA.org to request a cost estimate of your purchase. VCERA will need several weeks to research and calculate the cost estimate. Generally, the longer you delay in purchasing prior service, the more expensive it will become because of semi-annual interest accrual. So, you may want to start the purchase process as soon as possible. Reciprocity is an agreement between certain retirement systems in California that allows their members to move from one public agency in California to another without jeopardizing earned retirement benefits. By establishing reciprocity between retirement systems, total retirement benefits can actually increase. Qualifying systems include the California Public Employees Retirement System, CalPERS, agencies reciprocal to CalPERS, the California State Teachers Retirement System, CalSTRS, any other 1937 Act county retirement system, as well as the Judges Retirement System to a limited extent. In most cases, it is advantageous to establish reciprocity if you join a qualifying retirement system. For example, the age for determining your retirement contribution rate in the new system will be the same as your entry age in the first system. However, this feature is not applicable in retirement systems such as VCERA that use fixed contribution rates. Also, the service credit you earn in the first system will contribute to meeting your vesting and retirement eligibilities in the new system, so you don't start completely over when transitioning between retirement systems. And, if you were a member of the first reciprocal system prior to 2013, you may be eligible for a legacy benefit tier in the new system. That could result in a better benefit formula. Lastly, and perhaps most impactful, is that the highest salary you earn in any reciprocal system will be used by all reciprocal systems to determine your final average compensation, which will be used by all systems to calculate your respective retirement benefits. This could increase your monthly benefit from the retirement system where you earned less. To reap the benefits of reciprocity, you must adhere to certain rules. You must join the new reciprocal system within 6 months of leaving the first one, and you must leave your retirement contributions on deposit with the system you just left. If you are entering VCERA from a reciprocal system, you must officially request to establish incoming reciprocity using a VCERA form. Later, you must retire on the same day from all reciprocal retirement systems. California is a community property state, which means that your former spouse may have a community property interest in the VCERA benefits you earned during the marriage. This is because your VCERA benefit will likely be considered a community property asset by the courts. As an active or deferred member, VCERA must have certain documents before it can issue your first retirement check. If you are divorced, the required paperwork includes your final judgment and your court-filed domestic relations order, which provides specific instructions to VCERA on how to pay benefits to you and your former spouse. VCERA's procedure for resolving community property claims depends on whether your domestic relations order requires that you and your former spouse share a benefit or whether your account will be split into two separate accounts. Generally, active members are ordered to have separate accounts so that each party has control over the retirement contributions and service credit awarded to them individually. At your request, VCERA will perform a pre-judgment valuation that provides the service credit and dollar value of the VCERA assets accrued during your community property period. The valuation will also show your earliest available retirement date and estimate your monthly benefit amount. The subjects of divorce, community property, and retirement benefits are complex. To assist you through this process and to answer common questions, VCERA has produced a very informative booklet located on the Divorce and Community Property page at VCERA.org. Please review it carefully and then contact VCERA to speak with a benefits specialist. Before we conclude this presentation, let's look briefly at two checklists, one for pre-retirement and one for post-retirement. Here are some things to consider a few months before you retire. First, complete and submit your VCERA retirement application packet within 60 days of your retirement date. The packet will include an application on which you will pick a retirement date and elect a retirement option. You will also designate your beneficiary, update your contact information if applicable, set up direct deposit of your benefit payment, and elect your federal and state tax withholdings. While you are still a few months out from retirement, you should contact your reciprocal retirement systems to coordinate your retirement dates. You must complete any service purchases that remain outstanding. Please inform the HR representative in your department about your retirement plans so that the appropriate paperwork can be filed timely. And if you have a divorce in your past that will impact your VCERA benefits, please submit the required paperwork promptly. After you retire, there are a few important things to be aware of. Number 1. Your first monthly benefit payment from VCERA will arrive in 30 to 60 days, although certain factors such as reciprocity could cause a delay. VCERA must first receive your final payroll data and then process it and audit your retirement records. The timing of when you file for retirement and when the final payroll data is available to VCERA will determine whether you are placed on that month's payroll or on next month's payroll. In any case, your first VCERA benefit payment will include your first full month on retiree payroll and a retroactive payment back to your date of retirement. Number 2. It is inevitable that you will experience something in life that requires you to update your information with VCERA. If you marry or divorce, your name and beneficiary might change. If you move, your address will change. If your beneficiary passes away, you will need to name another. If you change bank accounts, you may need to set up a new direct deposit. You may also want to update your federal or state tax withholding preferences. VCERA has a form to update all of these things, and they can be found on the Forms page at VCERA.org. Number 3. Some members retire only to discover that they really miss working. If this is the case with you, you may return to work for a non-VCERA employer, that is, not the county, not the courts, not a participating district, with no effect on your VCERA benefit. However, if you want to return to the county, courts, or a participating district, several rules will apply. We've provided a visual representation of these rules and exceptions on a flowchart linked from the Returning to Work page at VCERA.org. Remember, do not accept VCERA-covered employment without talking to VCERA first, as your monthly benefit could be adversely affected. And lastly, retirees may also experience divorce and legal separation. The same documentation requirements apply. You will need to submit your judgment and domestic relations order. Generally speaking, VCERA retirees must share a benefit with a former spouse. There is not a separate account option. Again, visit the divorce page at VCERA.org for more information about divorce, both before and after retirement. Although this presentation addressed several retirement-related topics, there is much more information available. VCERA offers an array of online resources and tools to better assist in your retirement planning and education. For example, on the VCERA website, you will find 2 pension calculators, one for legacy members, one for Pepper members, several topical publications, numerous forms, and a password-protected member portal on which you can directly access your retirement account information. On the portal, you can run unlimited benefit estimates using up-to-date salary and service data. If you have not already registered for a portal account, please do so today. Call VCERA to request a portal registration letter. And, as always, if you have questions or you need to speak with a benefits specialist about your retirement plans, please call VCERA at area code 805-339-4250. The office is open Monday through Friday from 8 a.m. to 5 p.m., except for county holidays. If you prefer a face-to-face appointment, please call ahead so that someone is available to meet with you. On behalf of VCERA and its staff, thank you for watching this presentation. We look forward to serving you for many years to come.